Hello and welcome to Moneylife News and Views. I am Debashis Basu. If you are a retiree and you have opened a broking account with any of the large brand name stockbrokers, the following series of events could happen to you. You will get a call from your so-called relationship manager making verbal promises of helping you earn a steady income every month by selling call and put options. He will explain to you that the trading positions are hedged and there is nil or very negligible risk. You hand over your investment portfolio of, let's say, about 1.25 crore, your entire retirement savings, maybe across 57 scrips, and many of them blue chips such as Hindustan Lever, Asian Paints, Dabur, etc. Now the broker opens a futures and options account and makes some profit. The only way he could have promised a steady return in stock market is by selling puts and calls. Now this works very well when the market volatility is low. You sell options, the market remains in the narrow range, the options lose value and go to zero at the end of it, and you've pocketed the premium that you've sold. And then comes a market crash, one of the steep falls that happen once in a while for which no one is prepared. Your broker and the smooth talking, expertise-free relationship manager, they are as clueless as you are. When the market crashes, the puts you've sold, which were making steady money for you, shoot up higher in value than you sold. Now they're much higher in value, so either you have to square off at a loss or you have to expire them at a much bigger loss. Suddenly, the friendly broker has a different tune. You are asked to pay up for the loss, of course, or your 1.25 crore stash of blue chip shares, which is with the broker's demat account, will get sold off. You protest, but the system created and tinkered endlessly by the market regulator is on the broker's side. The broker sells out your life savings. This is a real story of a retiree. Here is another real life story of an investor of a rich family with operations in multiple countries. In the crash of March, recent one, he lost about 10.43 crores in futures and options and claims to have lost another 7.5 crore when the broker sold off his blue chip stock in his account to recover mark-to-market losses. The client claims that he did not know that the broker had built up a huge position in F&O. The broker, one of the best brands in the business, points out that all trades were executed with the knowledge and consent of the client's authorized person. It had sent contract notes and text messages and also net ledger balances, and so the client should have known. Now, the number of people who lose money this way in F&O trading is endless, some small, some large. The problem here is harmful advice, inducement by the broker, poor skills on behalf of the broker, and of course, no knowledge on the part of the investor, all of these things combined. And then there is fraud. In recent years, thousands of investors have lost money in a dozen stockbroking firms that went bankrupt, such as Amrapali, Adya Trading Investments, Kasaf Invest, Unicorn, then Click to Trade, Allied Financial Services, Fairwealth, and so on. Some brokers like BMA, Modex, and Kavi are also said to have misappropriated client money running into thousands of crores. The surprising thing in all this is that stockbroking, like every aspect of the securities market, has been extremely closely regulated for the past 28 years after the Securities Exchange Board of India came into existence. Brokers have to pass exams, put in place half a dozen policies, including code of conduct, are subjected to regular audits, and of course inspections by the exchanges. And yet, dealing with stockbrokers can mean malfeasance, horrible advice, bad faith, incompetence, and outright fraud. What is going on? The stockbroking model is broken. The problem is what brokers are allowed to do. SEBI needs to go back to basics and question the very basic role and function of a stockbroker and what needs of investors they are fulfilling. Dr. R.H. Patil, pioneer of modern stock exchanges in India, was an original thinker, and he always felt we don't need stockbrokers at all. Now, I'm not suggesting that we do away with stockbrokers, but interestingly, remember, SEBI has already assured that brokers, or as they are called, distributors, are not needed to buy mutual funds, which by the way is another risk asset exactly like stocks. Now, how to fix the broken stockbroking model? SEBI must start thinking of fundamentally redesigning the role of stockbrokers so that they can do no harm or much less harm. Until SEBI was set up, stockbrokers were the only market intermediaries and they performed multiple functions. Then specialized market intermediaries were licensed, such as portfolio managers, depositories, custodians, investment advisors, and research analysts. Each one of them, each category is covered by specific SEBI regulations and a whole lot of very close sort of regulations that cover them. So now there is no reason to allow brokers to perform any of these functions anymore. Advisors and research analysts can offer stock advice. Banks, depositories, and custodians, which is really the pipelines which put through transactions, can handle transacted assets and also hold them, such as custodians do. And portfolio managers can manage investments. Investors suffer because stockbrokers continue to don the hats of advisors, custodians, and portfolio managers, sometimes doing each of these functions very badly. Stockbrokers can very easily be limited to execution of trades, like a toll operator maintains roads. Now, toll operators don't give you driving advice or which cars to buy. This should obviously be the standard model for stockbrokers if SEBI wants to make the market much safer for you and me. Thanks for watching.